Section 1. Today's crypto roller coaster, up, down, and sideways. Alright everyone, welcome back to the channel. Let's get right into it. Today's date, October 23rd, 2025. The market is moving fast and you can't miss this. On one hand, the market is showing serious signs of life. Total crypto market cap up 1.3% to $3.8 trillion. This isn't just one or two coins. We're seeing a broad recovery. 80 out of the top 100 coins appreciated in the last 24 hours. Leading the charge, Bitcoin. Bitcoin trading just under 109,789, up 1.7%. Ethereum holding at about 3,175, up 0.3%. BTC and ETH moving higher gives people confidence. It sets a positive tone for the whole ecosystem. Altcoins often follow, but it's not all sunshine. We need to look deeper. Some serious risks are lurking. While the daily chart looks encouraging, overall sentiment is still shaky. Fear and greed. Index 33. Slight improvement from yesterday's 30. Big drop from last week's 42. Even with price gains, investors remain cautious and nervous. That tug of war could send the market swinging either way. That's why today's update is critical. We'll break this down piece by piece. We'll look at short-term price action. But more importantly, we'll dive into the big themes pulling strings. Massive whale losses that could trigger a sell-off. Significant money flowing out of Bitcoin ETFs. Regulatory roadblocks from the US government shutdown. Major economic events on the horizon. The upcoming CPI release. My goal, give you everything you need to navigate this, all in about 15 minutes. Section 2. The big picture. What's really driving the market? Let's set the stage for the rest of our discussion. The market isn't moving from random clicks. Buy-sell powerful forces are at play. Understanding them is the key to smarter decisions. First major story, the whales. On-chain data shows new Bitcoin whales, sitting on almost $7 billion in unrealized losses. That's the largest we've seen since last October. When big investors are underwater, it creates pressure. They might be forced to sell to cover positions, which could send prices tumbling. Institutional money is showing hesitation. US Bitcoin ETFs were a huge catalyst for growth. Diagram: Bitcoin ETFs, spot market, net outflows. Today's net outflow, about $40,470,000. Don't panic over a single day of data, but it's a trend to watch. If big money pulls back, it removes a major source of buying pressure. We'll dig into what these outflows mean for Bitcoin's price going forward. It's a crucial piece many people are overlooking right now. Then there's the regulatory headache. A US government shutdown is causing a massive logjam at the SEC. There are 155 crypto ETF filings waiting for review. That includes 20 proposals for an XRP ETF. These delays are hurting sentiment. XRP has seen its price suffer. We'll explore what this shutdown means for the future of crypto regulation. The outcome could unlock a new wave of investment or lead to further frustration and price declines across the board. Finally, we have to look at the macro environment. The Federal Reserve is holding a major conference to discuss crypto, AI. That shows how seriously they are taking this space. Plus, CPI inflation data is coming out this week. The expectation is for inflation to tick up to 3.1%. A higher than expected number could spook markets and lead to a sell-off in risk assets like crypto. We're also seeing renewed trade tensions between the US and China, which wiped out some recent gains. And amidst all this, Bitcoin miners are taking on billions in debt to expand. It's a complicated, high-stakes environment, so stick with me as we break it all down. Section 1. Breaking down the price action. Let's start by digging a little deeper into the price movements we're seeing today. A 1.7% gain for Bitcoin might not sound like a huge deal, but context is everything. After the recent volatility and sharp drops, any upward move is a welcome sign. It pushes Bitcoin back toward the critical $110,000 resistance. A decisive break above this could mean buyers are back in control. That could open the door to a run toward previous highs. If it fails to break through, it looks like weakness. Sellers could push price down again. It's a tug of war at this exact price point. Ethereum's move is more subdued, about 0.3% to 3,175. Often when Bitcoin rallies, Ethereum follows with more momentum. The fact ETH is lagging could mean traders are rotating into BTC. Or it could be a temporary pause before ETH catches up. If Ethereum breaks and holds above $4,000, that would be bullish for ETH and the broader altcoin market. Total market cap, $3.8 trillion. Up 1.3% today, roughly $49 billion added. That's a meaningful inflow of fresh capital. The key question, is this sustainable? A one-day blip from news, or the start of a larger trend? Recent price action has been choppy and sideways. Today's move pushes toward the top of that range. Positive, but not decisive. After big moves, we often see profit-taking. Traders who bought lower may cash gains, creating selling pressure. Volatility can spike as buyer clusters and seller clusters clash around key technical levels. Think of a battle line being drawn in the sand. For the uptrend to continue, buyers must absorb selling pressure and push prices higher. That's the current market challenge. Section 2. Leaders, laggards, AI anomaly. When we say the market is up, it's never the full story. We need to look at which sectors are leading and which are left behind. Today, the standout performer, the AI token sector. It's up 4.51% in the last 24 hours. Second straight day of strong performance. Bigger coins are posting modest gains. Bitcoin, Ethereum. That divergence signals a narrative forming. The theme is artificial intelligence, a pocket of extreme strength in a hesitant market. Leading the AI rally, Chain Opera AI, Co-AI. Top performers list showing Co-AI, plus in 56.47%, and other AI tokens green. Moves like this draw speculative interest. Traders see massive gains and jump in to catch the wave. That creates a short-term, self-fulfilling momentum. It's also a sign of a highly speculative environment. AI narrative is powerful, but parabolic moves are rarely sustainable. These are often followed by sharp corrections. So, celebrate the sector, but exercise extreme caution chasing pumps. On the flip side, laggards. Layer 2 solutions have been struggling, recently down 5.15%. Layer 2s help Ethereum scale. Their performance ties to broader ecosystem health. Could signal network congestion, or competition, or rotation of capital into hotter sectors like AI. Recovery isn't lifting all boats equally. You could own a solid project in a lagging sector and still lose money. Don't just look at Bitcoin. The market is becoming segmented. Sectors behave like industries. DeFi, NFTs, gaming, Layer 1s, Layer 2s, AI sector. Each has its own drivers, its own risks, its own community. AI up while Layer 2s fall tells us investors are becoming more selective. They're making specific bets on technologies and narratives they think will outperform. So, I've mentioned market breadth a couple of times, and it's a concept you absolutely need to understand. When we see that 80 out of the top 100 coins are rising, that's a signal of strong market breadth. Think of it like this. If the army is advancing, you want to see all the soldiers moving forward together, not just the general. In the market, Bitcoin and Ethereum are the generals. If only they are moving up, while most other coins, the soldiers, are falling. It's a sign of a weak and unhealthy rally. It suggests the positive sentiment is very narrow and could easily reverse. On the other hand, what we're seeing today is a broad-based recovery, with 80% of the top coins in the green. It tells us that buying pressure is widespread. This is a much healthier sign for the market. It indicates the recovery has legs and isn't just dependent on the performance of one or two assets. It lowers the overall risk because the market's foundation is wider and more stable. If Bitcoin were to suddenly dip, the losses might be cushioned because other parts of the market are also showing strength. Let's use a simple example to make this crystal clear. Imagine you have a portfolio of 10 different cryptocurrencies. If the market is up, but only your Bitcoin holding is in the green, while the other 9 are down, your portfolio is probably losing money. This is a market with poor breadth. Now imagine a day like today, where the market is up and 8 of your 10 coins are in the green. Even if some of the gains are small, your overall portfolio is likely doing very well. This is a market with strong breadth. It's what you want to see as an investor because it increases your odds of picking a winner. This is why analysts and experienced traders pay so much attention to metrics, like the number of advancing versus declining coins. It gives them a read on the underlying health and conviction of a market trend. A rally built on strong breadth is far more trustworthy and more likely to continue than one built on the narrow shoulders of just a few megacap coins. The fact that we have 80 of the top 100 coins moving higher is one of the most bullish short-term signals we have right now, even with all the other risks we're about to discuss. It shows a genuine, widespread return of confidence among buyers. You might be wondering, where do all these numbers even come from? How does someone calculate that the total market cap is 3.8 trillion, or that 80 out of 100 coins are up? It's not as simple as it sounds. It's important to know how this data is collected. The process relies on data aggregators. Think sites like CoinMarketCap or CoinGecko. These platforms pull price feeds from hundreds of different exchanges all around the world in real time. They track the price of Bitcoin on Coinbase, Binance, Kraken, and many others, all at the same time. To get a single representative price for a coin like Bitcoin, these aggregators use a volume-weighted average. They don't just average the prices from all exchanges equally. Instead, they give more weight to the exchanges with higher trading volume. That prevents a small exchange with very little activity from having an outsized impact on the global average price. It's a much more accurate way to reflect what the majority of the market is actually paying for an asset at any given moment. This is the price you typically see quoted in headlines and on your favorite crypto app. Calculating total market capitalization then becomes a straightforward math problem. The aggregator takes the volume-weighted average price of each cryptocurrency and multiplies it by its current circulating supply. For Bitcoin, that would be its price of around $109,789, multiplied by the number of Bitcoins that have been mined. They do this for every single one of the thousands of coins they track, and then add all those individual market caps together. That final sum is the total crypto market cap. In our case, the 3.8 trillion figure we're seeing today. So, when a report says that 80 of the top 100 coins have appreciated, it means the aggregator has compared the current volume-weighted price of each of those top 100 coins to its price 24 hours ago. It's a massive data crunching operation that happens continuously, 24/7. Understanding this process is important because it helps you appreciate that these numbers are aggregates and averages. Your specific exchange might show a slightly different price, and that's perfectly normal. But these aggregated figures are what give us the indispensable bird's-eye view of the market's health, breadth, and overall direction. Now, we have to get into the less comfortable part, the stuff that keeps me cautious even on a green day. Beneath the surface of these rising prices, there's a serious storm brewing. It involves the biggest players in the game, the Bitcoin whales. On-chain data is flashing a major warning sign. It shows a specific group of whales, those who bought relatively recently. They are sitting on nearly $7 billion in unrealized losses. This is the largest paper loss for this cohort since October last year. It's a staggering amount to be in the red. These aren't your average retail investors who bought a few $100s. Whales are individuals or institutions holding massive crypto, enough to influence the market if they decide to sell. The newer whales are the ones underwater. That's particularly concerning. It suggests they bought near the recent market top and are now trapped. They expected the price to keep rising, but the market turned against them. Now they're faced with a difficult choice: hold on and hope for a recovery, or cut their losses and sell, which could trigger the very price drop they fear. This isn't theoretical. It has real-world implications for every crypto investor. A small group of wallets holding a large underwater position creates an overhang on the market. Think of it as a massive boulder teetering on the edge of a cliff. As long as it stays there, everything is fine. If it starts to fall, it will cause an avalanche. If whales begin to sell, they could flood the market with sell orders. That would overwhelm existing buyers and send Bitcoin into a downward spiral. This is significant selling pressure we cannot ignore. The psychological impact matters too. Knowing big players are losing can damage market confidence. Smaller investors might think, if the smart money is losing, what chance do I have? That can lead to a wave of panic selling. It creates a feedback loop of fear that can cause the sell-off it expects. This is why on-chain data is so powerful. It shows the financial health of the market's biggest players. Right now, it's telling us they are under serious stress. So, why do we obsess over what these large wallets are doing? It's a practice often called whale watching, and in the volatile world of crypto, it's less of a hobby and more of a critical survival skill. These whales matter because of their sheer size. A typical retail investor selling their Bitcoin might not even cause a ripple. But when a whale sells, it's like a cannonball hitting the water. They can place sell orders so large they absorb all current buy orders, and then keep pushing the price down until they find enough new buyers. Their actions hit market liquidity and price stability immediately. Understanding their behavior helps us anticipate market moves. For example, if on-chain data shows whales moving large amounts of Bitcoin onto exchanges, that's often a bearish signal. Because you generally move crypto to an exchange to sell, it's like a poker player shoving a huge stack of chips into the middle, a sign they're about to act. Conversely, whales moving coins off exchanges into cold storage is bullish. They plan to hold. Right now, the worry is their $7 billion loss might force them to move coins to exchanges. Metaphor time. Imagine the crypto market is a small swimming pool. Retail investors are people splashing around the edges. They make waves, but the water level stays about the same. Whales can do a cannonball from the high dive. When they jump in, the water level rises for everyone. When they get out, the level drops and some people are left high and dry. Their losses matter because if they leave to stay warm, the whole pool level can drop suddenly. That's why things feel tense. These new whales are precarious. Their losses reduce their ability to buy and support the market. Worse, they become potential massive supply. Every price dip increases pressure to capitulate and sell. As an investor, be aware of this risk. It doesn't mean panic and sell everything, but be prepared for volatility. Know this selling pressure could come, so set your stop losses, manage your position sizes. Avoid being caught completely off guard if a sudden drop occurs. Now let's pivot to the second major headwind, the institutional side of the market, specifically the US Bitcoin ETFs. After a period of massive inflows that helped fuel the rally earlier this year, we are now seeing a change in the tide. On October 20th, these ETFs recorded a net outflow of $40.47 million. In a multi-trillion-dollar market that might sound like pocket change, but the direction of the flow matters more than the number. A net outflow equals more money pulled out than put in. It's a sign of waning demand from institutional and mainstream investors. To see why this matters, here's how ETFs work. When an investor buys a share of BlackRock's IBIT or Fidelity's FBTC, the authorized participant has to buy actual Bitcoin on the spot market. That creates real buying pressure. For months, those constant inflows were a massive, consistent buyer every single day. That buying absorbed selling and pushed prices higher, a huge tailwind for Bitcoin. With net outflows, the reverse happens. Investors sell ETF shares. The fund manager must sell the corresponding Bitcoin on the spot market. Use marketing diagram here. So a $40.47 net outflow means $40.47 of real Bitcoin was sold. That adds selling pressure to the market. Instead of a giant daily buyer, the market now has to contend with a new, potentially large seller. That's a fundamental shift that can drag the price down. One day of outflows, even small, can make investors nervous. Is this a one-off or the start of a trend? Are big money investors taking profits and stepping back? If outflows continue or accelerate, the tailwind could quickly become a headwind. Institutional demand might be drying up, forcing the market to stand on its own. It is absolutely crucial that we distinguish between two very different numbers here: net flows and trading volume. They tell us completely different stories about what's happening with these ETFs. The net outflow figure we discussed was 40.47 million. This represents the net amount of money that left the funds at the end of the day. However, the total trading volume for these ETFs on that same day was a massive 4.87 billion. Side by side, 487B trading volume on the left, 4047 mere net outflow on the right. This means that billions of dollars worth of ETF shares changed hands throughout the day. Buyers and sellers. But at the end of it all, the sellers outweighed the buyers by about 40 million. Think of it like a busy store. The trading volume is the total number of people coming in and going out of the store all day long. A high volume of 4.87 billion means the store was incredibly busy, with tons of activity and interest. The net flow, however, is like the store's final sales tally for the day. Did more people buy things, or did more people return things? In this case, slightly more was returned than was bought, resulting in a net loss for the day. The high trading volume tells us that interest in Bitcoin ETFs is still incredibly high, but the net outflow tells us the short-term sentiment among those traders has turned slightly negative. Seeing a 4.87 billion trading volume is actually a healthy sign. It shows that there is deep liquidity and a very active market for these products. It's not as if everyone has lost interest and walked away. Buyers and sellers. The problem is just that, on this particular day, the sellers had a slight edge. This is much less concerning than a scenario where we have net outflows and very low trading volume, which would suggest that interest is drying up completely, and the only people left are the ones trying to get out. So, while the outflow itself is a bearish signal that adds selling pressure to the spot market, the high trading volume provides a more nuanced picture. It tells us that this is a dynamic and contested market. Bulls and bears. For now, the bears have won a small victory, but the war is far from over. The high volume indicates that it wouldn't take much of a shift in sentiment for the flows to turn positive again. A single positive news story could easily swing that pendulum back, turning the 40 million outflow into a 100 million inflow on the very next day. Section 5. Reading the tea leaves. Potential scenarios for Bitcoin. So, what does all this mean for the price of Bitcoin? Let's game out a few potential scenarios based on these whale losses and ETF flows. Quick overview. 3 possible paths. Bearish path, down arrow. ETF outflows continue. Institutional players selling on the spot market. Price dips further, adding pressure. Whales are sitting on roughly $7 billion in losses. Eventually, one or more whales capitulates and starts selling. A flood of supply from ETFs and whales could overwhelm buyers. That can produce a sharp, rapid price correction. Neutral path, sideways arrow. ETF flows stay choppy. Small outflows some days, and small inflows on other days. They cancel each other out. Institutional support is neutral. Whales choose to hold and weather the paper losses. Result, choppy sideways price action within a defined range. Bullish path, up arrow. The recent outflow is just a blip. Institutional inflows return with force. Renewed buying pressure pushes price higher. Whales feel relief and may buy the dip. That combo could propel Bitcoin to test new all-time highs. Ultimately, which scenario plays out depends on the next few days and weeks. Key metric 1. Daily ETF flow data. Key metric 2. On-chain alerts for large wallet movements. If you see headlines about another day of significant ETF outflows, be cautious. If you see alerts that whales are moving large sums onto exchanges, major red flag. Conversely, if ETF flows turn positive and whales accumulate, that could be the green light. This is a high-stakes environment where the actions of a few can determine direction for the many. Section 1. The government shutdown hits crypto. Alright, let's move on to another major factor weighing on the market. Something that has nothing to do with charts or whales, but everything to do with politics. I'm talking about the US government shutdown. Now, you might think a shutdown in Washington, D.C. is just political drama that doesn't affect us in the crypto world, but you'd be wrong. It's creating a massive roadblock for the entire industry. The Securities and Exchange Commission, or the SEC, is the main regulator for financial markets. It's operating with a skeleton crew. This means most of their normal work has ground to a halt. A huge part of that work is reviewing new financial products, including the crypto ETFs everyone is excited about. There is a staggering pile of 155 crypto ETF filings. These are proposals from some of the biggest names in finance: BlackRock, Fidelity, VanEck. Each filing needs a detailed and lengthy SEC review. That can't happen while staff are furloughed. The shutdown has frozen the pipeline for new regulated crypto products in the US. That regulatory paralysis creates a huge amount of uncertainty. For months, the narrative was more institutional adoption, driven by a wider variety of crypto ETFs. We already got the Bitcoin ETFs. The market was eagerly anticipating the next wave, expected to include Ethereum, potentially XRP, and other assets. That wave was a big source of bullish sentiment. Investors were front-running potential inflows into those ETFs. But with the shutdown, that catalyst is on indefinite hold. No one knows when the government will reopen or when the SEC will get back to work. It's like putting the brakes on a race car just as it starts to accelerate. It kills momentum. It forces investors to question the timeline for crypto's integration into mainstream finance. If the shutdown drags on, investor enthusiasm could cool significantly. Money waiting on the sidelines might go elsewhere. This is a variable outside the crypto market's control, yet it directly hurts sentiment and future growth. The market hates uncertainty. A government shutdown is the definition of uncertainty. Section 2. XRP, caught in the crossfire. While the shutdown affects the entire crypto space, one asset is feeling the pain more acutely than most: XRP. The XRP community and its investors have been desperately waiting for the approval of an XRP-focused ETF. There are currently 20 different proposals for XRP ETFs tied up in that massive backlog at the SEC. An ETF approval is seen as a major milestone for XRP, a form of validation that could finally bring it into the mainstream investment fold and unlock a huge wave of new capital. The anticipation around these ETFs has been a key part of the investment thesis for many XRP holders. Unfortunately for them, the shutdown has thrown a giant wrench into those plans. The delays are directly impacting XRP's price and market sentiment. Looking at the numbers, XRP has suffered a painful 15.7% decline over the past month. This underperformance compared to other major cryptos can be directly linked to the fading hopes of a near-term ETF approval. On top of that, data shows that inflows into XRP-related investment products have been weak, suggesting that even the existing institutional players are becoming hesitant. The combination of a stalled regulatory process and weak demand is creating a perfect storm of negative pressure on the asset. The situation is incredibly frustrating for XRP investors who have already endured a multi-year legal battle between Ripple and the SEC. Just when it seemed like they had achieved some legal clarity and the path was clear for products like an ETF, this external political issue has slammed the door shut. It feels like a case of, one step forward, two steps back. The hope that had been building in the community is now turning into frustration and impatience, which is being reflected in its price action. It's a clear example of how regulatory and political events can completely override a project's fundamental progress or technological developments. This also highlights a broader risk for altcoins. While Bitcoin has its ETFs up and running, other assets are still waiting for their turn at the regulatory table. Their fate is directly tied to the whims of regulators, and, in this case, the functioning of the US government itself. The delay for the XRP ETF serves as a stark reminder that the path to mainstream adoption is not a straight line. It's filled with bureaucratic hurdles and unexpected roadblocks. For XRP, being caught in this crossfire means it's not only battling for market share against other cryptos, but also against the political gridlock in Washington. So, with 155 filings in limbo, what can we expect once the government shutdown ends and the SEC is back at full capacity? It's highly unlikely the agency will approve them one by one in a slow trickle. The workload is simply too immense. Many analysts, myself included, believe the most probable scenario is batch approvals. This is a pattern we've seen before. When the agency decides to move on a product, they often approve multiple similar filings at once. They do this to avoid giving any single company a first-mover advantage. That batch approval theory is what many are pinning their hopes on. Once the shutdown lifts, expect a period of intense work at the SEC, followed by a major approval day. We could see a dozen or more crypto ETFs get the green light simultaneously. This could include multiple Ethereum ETFs, perhaps even the first batch of XRP ETFs. Such an event would be a massive catalyst for the market, likely triggering a significant rally across the board. New products would be made available to institutional investors. New products would be made available to retail investors. It would be a huge risk-on signal for crypto. But let's break down the timeline. First, the government has to reopen. Then, the SEC staff need time to get back up to speed. For each ETF filing, there's a multi-stage review. The SEC issues comments. Issuers respond with amendments. There are legally mandated windows for public comment. This all takes time. So, even after the shutdown ends, don't expect approvals the next day. It will likely take several weeks, if not a couple of months, for the SEC to ramp up. This waiting game is testing investors' patience. The potential reward of a batch approval is huge, but the timeline is uncertain. That's why the market reacts to any Washington news. A headline "the shutdown might end" could spark a relief rally in XRP. A similar headline could spark a relief rally in Ethereum. Conversely, worse political stalemate could lead to another leg down. Investors are forced to act like political analysts, trying to time entries and exits on these altcoins. This whole situation with the shutdown and the ETF delays really shines a spotlight on the broader relationship between crypto and regulation. For years, the crypto community has had a love-hate relationship with regulators. On one hand, the path to mainstream adoption and trillions from institutions needs clear regulatory frameworks. Regulation brings legitimacy. It provides investor protections and gives confidence for big pension funds and asset managers to allocate capital. Regulation is the key that unlocks the next major phase of growth. On the other hand, the process is slow, politically charged, and often arbitrary. The SEC's approach is described as regulation by enforcement, where the rules are not made clear ahead of time, but are instead established through lawsuits, like the long-running case against Ripple. That creates a climate of fear and uncertainty, stifling innovation as projects hesitate to build for fear of being sued later. The current ETF logjam is another example where the industry's progress is held hostage by bureaucracy and political inertia. It's a frustrating reality for an industry that moves at lightning speed. The delay in ETF approvals has a tangible impact on investor sentiment. It reinforces the narrative that crypto is still a Wild West, an unregulated frontier that's too risky for serious investors. This is why the approval of the Bitcoin ETFs was such a monumental event. It was a signal that the tide was finally turning. The current shutdown feels like that tide is now receding. Ultimately, investors have to accept that regulatory risk is one of the biggest and most unpredictable variables when investing in cryptocurrency. It's a double-edged sword. The promise of positive regulatory developments, like a batch of ETF approvals, can create incredible buying opportunities. But the risk of delays, denials, or an unfavorable new rule can cause prices to crash overnight. Navigating this requires a long-term perspective and an understanding that the road to regulatory clarity will be a bumpy one. The current shutdown is just one more bump in that road, albeit a very large and frustrating one for those invested in assets like XRP. Beyond the internal crypto market dynamics, we have to zoom out and look at the massive economic forces that can move all markets, including ours. This week, two major events are on every serious investor's radar. First, the Federal Reserve is holding its Payments Innovation Conference. Topic: crypto. Topic: stablecoins. Topic: artificial intelligence. This shows the highest financial authorities are no longer treating crypto as fringe. They're engaging with industry leaders to understand the technology and implications for finance. It's a long-term bullish sign of mainstream integration, but it also means crypto is now firmly on the government's radar for more regulation. The more immediate and potentially volatile event, however, is the upcoming release of the U.S. Consumer Price Index, or CPI data, on October 24th. This is the primary measure of inflation in the economy. Despite the government shutdown, this critical economic data is still being released. The current expectation is for a 3.1% year-over-year inflation rate. This is a slight but significant increase from the previous reading of 2.9%. A higher inflation number is generally bad news for risk assets like crypto and stocks. It signals the economy is still running too hot, which might force the Federal Reserve to keep interest rates higher for longer, or even consider another rate hike to cool things down. Why does this matter so much for your crypto portfolio? Because higher interest rates make safer investments, like government bonds, more attractive. If you can earn a guaranteed 5 or 6% on a U.S. Treasury bond, the idea of taking a risk on a volatile asset like Bitcoin becomes less appealing. This risk-off sentiment can cause capital to flow out of crypto and into safer havens, putting downward pressure on prices. The market's reaction to the CPI number will be instantaneous. If the number comes in higher than the 3.1% forecast, expect a sharp, negative reaction. If it comes in lower, it could trigger a relief rally. This is a perfect example of how crypto, for all its talk of being separate, is still deeply connected to the traditional macroeconomic environment. Decisions by a handful of people at the Federal Reserve, based on data points like CPI, can have a more significant impact on Bitcoin's price in a single day than weeks of project developments or on-chain activity. This is why you can't just follow crypto news. You need a basic understanding of the broader economy. This week, all eyes are on that inflation report, as it could set the tone for all markets for weeks to come. Now, let's talk about the people who form the backbone of the Bitcoin network, the miners. There's a fascinating and incredibly risky trend developing. VanEck reports total debt held by Bitcoin miners has absolutely exploded over the past year. It surged from $2.1 billion to a jaw-dropping $12.7 billion in just 12 months. That's a massive increase in leverage. Miners are making an enormous bet on the future. They're borrowing huge sums to finance a massive expansion. They're buying the latest, most efficient mining rigs. But they're not just investing in mining. Much of the borrowed capital is being funneled into AI infrastructure. Bitfarms, TeraWulf, Iron. They're raising billions through convertible notes and secured notes. They're using the money to build data centers and to buy high-powered GPUs for AI. The infrastructure built for mining can also serve the booming AI industry, creating a diversified revenue stream. It's high risk, high reward. On one hand, it's brilliant. AI demand is exploding, and miners are well positioned to capitalize. That could make their models more resilient and less dependent on Bitcoin's price. If Bitcoin crashes, they can pivot to AI clients and still earn revenue. On the other hand, this much debt is dangerous. Massive interest payments are due no matter what. A Bitcoin slump or slow AI revenue could leave them unable to service the debt. The sector is more fragile and sensitive to Bitcoin prices and interest rates. A sustained downturn could trigger defaults and bankruptcies among leveraged miners. As if domestic politics and economics weren't enough to worry about, we also have to contend with the ever-present risk of geopolitics. We saw a prime example of this just this past Tuesday. The crypto market was enjoying a nice rebound, prices were climbing, sentiment was improving. Then, headlines flashed across the screen saying former President Trump might pull the planned meeting with Xi. That single comment was enough to derail the crypto rally. The market's reaction was swift and brutal. Gains were wiped out in a matter of hours. Layer 2 led the losses with a steep 5.15% drop. Ethereum slid below 3,900 with a 1.99% decline. Bitcoin fell about 1.35% to roughly 108,000. This shows how sensitive crypto is to geopolitical news. It acts as a global barometer for risk appetite. When tensions rise between major powers, investors panic and dump the riskiest assets first. Right now, crypto is often seen as one of those riskiest assets. Why does a potential trade war affect Bitcoin? There are a couple reasons. First, broad economic uncertainty, tariffs, supply chain disruptions, slower global growth, all bad for markets. Second, it hits the Bitcoin as safe haven narrative. Some expect Bitcoin to act like digital gold in turmoil, but price action often shows the opposite. In acute panic, investors flee to the US dollar. Flight to safety means selling assets like stocks, crypto, to hold cash. Lesson: in a globally connected market, distant headlines can tank your portfolio. Geopolitical risk is unpredictable and can override everything short-term. It doesn't matter how good your project's tech is or how bullish the on-chain data looks, a single tweet or statement from a world leader can flip the market instantly. That's why solid risk management is non-negotiable. Be prepared for out-of-the-blue events that can erase gains and test your conviction as an investor. So, let's tie a few of these threads together because it paints a fascinating and somewhat contradictory picture. On one side, we have the major cryptocurrencies like Bitcoin and Ethereum struggling to find direction. These blue chips were showing clear signs of weakness and failing to hold key psychological levels. Bitcoin fell 1.29% to below 112,000. Ethereum dropped 2.60% to around 4,000. This points to a lack of broad conviction and a general sense of unease among investors. On the other side, the AI token sector is acting like it's in a completely different universe. That sector posted a 4.51% gain that day. It was the second consecutive day of strong performance. This isn't just a small bounce, it's a powerful rally driven by a very specific narrative. The excitement around artificial intelligence is a big part of that. NVIDIA, OpenAI. That excitement is spilling over into crypto projects tied to AI. Decentralized computing power, AI-driven analytics. Investors are bidding up their prices aggressively. This divergence creates what I call a tale of two markets. You can have one sector experiencing a full-blown bull run, while another is stuck in a sideways chop or even a downtrend. It's a sign of a maturing market. Investors making more nuanced bets rather than just buying the top 10 coins. They are rotating capital from sectors with fading narratives to those with growing momentum. For you as an investor, this means you need to pay closer attention to these micro trends. It highlights the importance of not being overexposed to a single coin or sector. While the AI rally is exciting, chasing these parabolic pumps is risky. At the same time, seeing the majors stumble while a niche sector explodes shows the market's appetite for risk is still there, but it's highly selective. The big question is whether the strength in the AI sector is a leading indicator for the rest of the market, or if it's simply a hot money rotation that will eventually fizzle out, leaving the broader market to contend with the macro headwinds we've discussed. So, after this whirlwind 15-minute tour, what's the final verdict on the state of crypto today? The picture is incredibly mixed. Anyone telling you they know for sure what happens next is just guessing. On one hand, we have the green on the screen. Total market cap is up. Bitcoin is pushing towards 110,000, 80% of the top coins rising. That's the good news. But on the other hand, the crypto fear and greed index is still flashing a score of 33, firmly in the fear zone. This tells us that despite the price bumps, the underlying sentiment is fragile, and investors are still on edge, ready to sell at the first sign of trouble. This caution is completely justified when you stack up the risks we've talked about. Key market risks. We have the massive $7 billion in unrealized losses hanging over the heads of new Bitcoin whales, creating a constant threat of a major sell-off. We have the institutional Bitcoin ETFs, seeing money flow out, removing a key source of buying pressure the market had come to rely on. Then there's the regulatory gridlock from the US government shutdown, which has frozen 155 ETF filings and is hitting assets like XRP especially hard. This is the kind of uncertainty that makes big money nervous and keeps it on the sidelines, waiting for a clearer signal before jumping back into the market. On top of all that, we have the huge macro events looming. The upcoming CPI inflation report could completely change the game for all risk assets, including crypto. A high number could send markets tumbling as fears of Fed rate hikes return. We also have Bitcoin miners who are now leveraged to the hilt, with over 12 billion in debt, making them incredibly vulnerable to a price drop. And as we saw with the US-China news, a single geopolitical headline can erase a week's worth of gains in an instant. It's a minefield of potential negative catalysts that you absolutely cannot afford to ignore right now. So, what's the final actionable takeaway for you? First, this is not the time to be chasing pumps or making impulsive, oversized bets. It's a time to be strategic. Stay informed, but don't let the daily headlines dictate your every move. Reevaluate your risk tolerance. Check your position sizing to make sure you can weather any sudden storms. Set alerts for key price levels. Set alerts for major news on ETF flows. Set alerts for the CPI data. Most importantly, have a plan. Know your entry points, your exit points, and your long-term goals. In a market this complex, planning your trades is infinitely better than trading the headlines. Thanks for watching, and I'll see you next time.